You hear about the AI revolution every single day, right? But today, we're going to pull back the curtain. We're not talking about the latest cool app. Nope, we are going to look at the real machinery, the actual trillion-dollar engine that's driving this entire boom. All right, let's get into it.
So to really wrap your head around the scale we're talking about, just look at this number, $2.02 trillion. That's what the world is projected to be spending on AI annually by 2026. And it's growing at a wild 36% a year. That's not just growth, that is a full-blown generational gold rush.
But here is the multi-trillion-dollar question. When you see a number that big, it's so easy to think, oh, that's all going to the geniuses building the next ChatGPT. But the real story, the story of who is getting systemically, unbelievably wealthy from this boom, well, it's a little more complicated than that. And honestly, the answer is fascinating.
So here's our game plan for this explainer. We're going to start with the sheer speed of this gold rush. Then we'll meet the most important players you might not have even heard of, the AI hyperscalers. We'll break down exactly how their engine works, and that includes a secret little financial loop you absolutely need to know about. Then we'll get into some major myths and risks, look at how the pros are trying to play this space, and wrap up with what's being called the Great Sorting Year.
Okay, first things first, let's look at the fuel for this fire, which is just jaw-dropping revenue. The numbers coming out of the top AI startups are unlike almost anything we've ever seen, and they show just how fast a tidal wave of cash is flooding into this space.
You know what's so wild about this slide is the speed. I mean, look at this. OpenAI is projected to hit $13 billion in annualized revenue. Anthropic, its main competitor, is already rocketing towards $7 billion. And even the newer players like xAI are blowing past $500 million right out of the gate. This incredible growth, this is the demand side of the equation. These are the prospectors, and they are digging for gold like their lives depend on it. But they all need something to even get started.
And that brings us to maybe the most important term in the entire AI economy today, the AI hyperscalers. These are the folks who really control the landscape. They own the very ground this whole revolution is being built on.
So what in the world is an AI hyperscaler? Well, to put it simply, it's one of a tiny handful of tech titans. You know who I'm talking about. Microsoft with Azure, Amazon with AWS, Google with Google Cloud. They provide the three things that every AI startup is absolutely desperate for. 1, massive cloud infrastructure. 2, enormous piles of cash for investment. And 3, the raw computing power from millions of specialized chips that you need to train and run these things.
And this slide just illustrates the whole dynamic perfectly. The best way to think about it is that old gold rush analogy. You've got the AI startups like OpenAI. They're the prospectors, digging like crazy for that digital gold. But the hyperscalers, they're the ones who own the entire town. They're selling the prospectors the picks and shovels, which in this case is cloud compute. They own the land the gold is on, and they even act as the bank, financing the whole expedition. It is an unbelievably powerful position to be.
So how does this engine actually work? I mean, what are the specific mechanisms that let the hyperscalers power this entire boom and profit so much from it? Let's break down the 4 core components that make the whole thing go. We're going to look at 4 key pieces. Now, I know, these terms might sound a little technical, industrialization of inference, agentic orchestration, but stick with me, because understanding what they actually mean is the key to seeing the whole picture. We're talking about a huge shift in business models, a massive physical build-out, the evolution towards smarter AI, and finally, a secret financial trick, the circular money loop.
Okay, step 1 is a massive shift in how tech actually works. For years, we've bought software as a service, or SaaS. You pay a monthly fee for a tool. Now, we are moving to outcome as a service. See, inference is just the fancy word for an AI model doing a job. So instead of buying a tool to help you with your accounting, you'll just hire an AI to complete your accounting. The value isn't in the software anymore, it's in the finished job.
Step 2 is so important because it busts a huge myth. AI feels weightless, right? Like it just exists in the cloud. But the reality is, this is a business of atoms. It needs a staggering physical build-out. We're talking about needing 3.5 times more global data center capacity by 2030, a project that's going to cost nearly $7 trillion. This means concrete, steel, gigawatt-scale power grids, crazy specialized liquid-to-chip cooling systems, and just endless miles of fiber optics.
And step 3 is all about how the AI itself is evolving. We started with chatbots that could, answer questions. We're now moving super fast toward agentic AI.
The best way to think about this is like upgrading from a simple tool to a digital chief of staff. These AI agents can read a company's private internal data. They can write reports or code, and they can take autonomous action on core business systems, like managing a whole supply chain without a human ever touching it. This is where those truly transformative productivity gains are supposed to come from.
Now for the fourth mechanism. We've talked tech, we've talked hardware, but now we have to talk about the money, because this next part is the secret ingredient. It's a clever piece of financial engineering that helps explain the sky-high valuations and makes this entire machine spin even faster. It is a brilliant self-reinforcing money loop.
It all starts out simply enough. A hyperscaler, let's say it's Microsoft, sees a really promising AI startup, like OpenAI. They put on their venture capitalist hat and invest a massive sum, let's call it $1 billion, to help that startup grow and to get a piece of the action.
But here it is. Here's the crucial second step, the real aha moment. That AI startup needs a ton of computing power to train its models, right? So where do they get it? Well, from the very same hyperscaler that just gave them the money. So a huge chunk of that investment, maybe $800 million of it, flows right back to the hyperscaler as payment for their cloud services. And this is the magic trick. The hyperscaler's investment is instantly transformed on paper into $800 million of brand new, high-margin cloud revenue. This makes their growth numbers look amazing, it gets Wall Street all excited, it pushes their stock price up, and all the while, they've locked in a future customer who depends on them. It's this brilliant circular flow of capital that can make growth look even more explosive than it already is. So, we've got this incredible engine and it's firing on all cylinders. But you know, whenever you have this much speed, this much money, and this much hype, you also get some major blind spots. So let's just pull over for a second and talk about the common myths, the very real risk of a bubble, and the potential for a serious breakdown. This quote draws a really powerful and kind of scary parallel. Remember the dot-com boom in the late 90s? Thousands of companies with a dot-com in their name got insane amounts of money. Then came the bust, and only a handful of giants like Amazon and Google were left standing. A lot of experts are seeing the exact same pattern forming right now. A massive boom followed by a painful bust that will separate the real, durable companies from all the hype.
And this isn't just some vague feeling people have. Check out this data from Vanguard, one of the biggest investment managers on the planet. They estimate there's a 25 to 30% chance that AI completely fails to deliver the economic growth that everyone is banking on, which would make today's valuations totally unsustainable. Now, they do think a productivity boom is the most likely outcome, but a 1 in 4 chance of a massive bust? That is a huge risk hanging over this whole market. So let's bust a few common myths really quickly. First up, this idea that the Magnificent Seven tech stocks are all one big AI trade. The reality is, their strategies are actually splitting apart. You've got Meta and Google making these high-risk, high-reward bets on building their own models from scratch, while Microsoft and Amazon are focusing more on being the infrastructure providers for everyone else. The performance gap between these stocks has already widened over 50%. They are not the same bet. And that brings us to the next big myth, that AI is purely digital. As we talked about, it's really not. Its growth is fundamentally tied to real-world bottlenecks. I mean, you can't just spin up a new data center overnight. It takes years of construction permits. You can't power it without access to a massive power grid, and you can't cool all those chips without a reliable source of water. These are hard physical limits to how fast this can all grow. And the third big one, that AI is coming to immediately replace millions of workers. Now, long-term displacement is a very real concern for sure, but the phase we're in right now is what experts are calling superstaffing. AI is acting as this incredible tool to augment human workers, to make them way more productive. And get this, the data actually shows that jobs with high exposure to AI are currently seeing higher job and wage growth than the rest of the market, not lower. So with all of these risks and complexities, how are investors and strategists even thinking about this space? Do you just avoid it? Well, this is where the smart money goes right back to our gold rush analogy. It brings us to the picks and shovels playbook. The core idea here is really simple, but it's powerful. Instead of trying to bet on which AI startup is going to strike it rich, you invest in the companies that sell the essential gear to all the prospectors. This means you look past the obvious names like NVIDIA and you focus on the less glamorous but absolutely vital infrastructure layers. The power companies, the cooling specialists, the networking wizards, and the construction firms that actually build this stuff.
And this slide just makes that strategy super tangible. In thermal management, which is critical because these AI chips run incredibly hot, you've got companies like Vertiv and Modine making specialized cooling systems. For networking, you need companies like Arista and Marvell for the high-density connections inside data centers. And for the enormous power needs, you have infrastructure players represented by ETFs like POWR. This approach is a bet on the entire ecosystem's build-out, not just on one model becoming the big winner.
So we've seen the engine, we've looked at the risks, and we've walked through a potential strategy. And all of this brings us to the final showdown, a period that many experts are calling the Great Sorting Year, where all this hype will finally be forced to meet reality.
I love this quote from the legendary trader Jesse Livermore because it just perfectly frames this moment. We have a lot of very strong, very smart opinions on all sides of this AI debate, but in the end, the market itself will be the final judge of who is right. And those opinions could not be more different. On one side, you have the respected investment firm GMO. They're famous for calling market tops, and they're calling this an extreme bubble that is destined to burst, just like the dot-com era. But on the other side, you have BlackRock, the world's largest asset manager, arguing that all this crazy spending is just the necessary investment to build the foundation for a historic productivity boom. They can't both be right.
And that leaves all of us with the final, crucial question. Is what we're watching right now a massive, speculative bubble, just inflated by hype and some clever circular financing? Or are we truly witnessing the expensive, messy, but ultimately necessary build-out of the next industrial revolution? The next few years are going to give us the answer, and whatever it is, it's going to shape our economy for decades.